Here's something that might surprise you. Commercial real estate generates roughly $16 trillion in assets across the United States alone. And most individual investors think they need millions to get a piece of it. They don't. In the next few minutes, you're going to understand exactly how beginners access this market, why it outperforms residential in three specific ways, and the single strategy that separates people who build real wealth from those who just own rental properties. I'll see you on the other side. Let's start with why commercial real estate even matters for someone like you. The big difference between residential and commercial comes down to three words: lease length. A residential tenant signs a 12-month lease, maybe 2 years if you're lucky. A commercial tenant signs 5, 10, sometimes 20-year leases. That changes everything about how you manage the investment. Imagine collecting rent from the same Starbucks for 15 years straight. No turnover, no month-to-month panic. That's the commercial model. Here's the first approach any beginner can use today. Real estate investment trusts, REITs. These are companies that own portfolios of commercial properties. You buy shares just like a stock, but unlike stocks, they're required by law to distribute at least 90% of their taxable income to shareholders as dividends. That means you're getting paid to hold real estate without ever signing a deed. Vanguard's Real Estate Index Fund has delivered an average annual return around 8% over the past decade. Some individual REITs have done significantly better. Simon Property Group, the biggest mall operator in America, paid out dividends totaling over $17 per share last year alone. You can start with as little as the price of one share. That's it. Now here's where it gets more interesting. Beyond REITs, there are private real estate platforms that let you invest in individual commercial deals. Companies like CrowdStreet, RealCrowd, and YieldStreet have opened up direct commercial investing to accredited investors. Think about what that means. You could own a piece of an apartment complex in Austin or an industrial warehouse in Nashville without ever visiting either property. A friend of mine, we'll call him Marcus, put $25,000 into a CrowdStreet industrial deal in 2021. The property was a last-mile distribution facility outside Atlanta. By 2023, he had received distributions totaling 31% of his initial investment. That's not annual return. That's total return over 2 years. The power of commercial real estate is that institutional investors, pension funds, and insurance companies chase these deals constantly. When you get access through these platforms, you're investing alongside them. If you're finding this useful, hit subscribe. I drop videos like this every week, and the next strategy I'm about to share is the one most people never hear about. Okay, ready for the next level? This is where things get really powerful. Let me tell you about the triple net lease, NNN leases. In a typical commercial lease, the landlord pays for property taxes, insurance, maintenance, and repairs. In a triple net lease, the tenant covers all of that. You, as the investor, just collect rent. The tenant handles everything: roof, HVAC, parking lot, property taxes. You wake up and check your bank account. That's it. A 2024 study from the National Real Estate Investor found that NNN properties in prime locations, think Dollar General, AutoZone, FedEx distribution centers, have vacancy rates below 2% nationally. Compare that to office space in major cities, which sits around 20% vacant right now. The stability is extraordinary. But here's the real secret that most beginners miss. Commercial real estate isn't just about rental income. It's about debt structure. When you buy a residential property, you typically put down 20% and the bank handles the rest. When institutional investors buy commercial properties, they often use creative financing that turns a modest down payment into massive returns. Consider this scenario. You find a small strip mall valued at $2 million. You put down $400,000. That's 20%. The property generates $200,000 a year in net operating income. After debt service, you're pocketing roughly $80,000 annually. That's a 20% cash-on-cash return on your $400,000 investment. Try getting that from a savings account. I dare you. Now I want to share something most people never figure out until years in. The real money in commercial real estate isn't from rent checks. It's from value-add deals. This is the strategy that separates professional investors from passive landlords. Here's how it works. You identify an underperforming commercial property. Maybe it's a retail strip with half the spaces vacant, or an office building with old finishes and unhappy tenants. You buy it below market value because of its current problems. Then you invest in renovations, better tenant mix, improved management. Rents go up. Occupancy goes up. The property's value goes up. A property generating $500,000 in NOI at a 6% cap rate is worth roughly $8.3 million. Bump that NOI to $700,000 and suddenly it's worth $11.7 million. You didn't add a single square foot. You just managed the asset better. That's where the wealth is built. Let me give you a real example. In 2019, a private equity group acquired a struggling Class B office building in Charlotte, North Carolina for $4.2 million. The building was 60% occupied. Tenants were leaving. It needed roughly $800,000 in capital improvements. The group invested that money over 18 months. They renovated the lobby, added amenity spaces, signed new creditworthy tenants at market rates. By 2022, the property was 95% occupied, with NOI climbing to $1.2 million annually. They sold it for $8.9 million. That's more than double their money in 3 years. And they did it on a foundation of $400,000 in equity plus the renovation budget. That's the game. So, here's where you start. First, open a brokerage account if you don't have one and buy a diversified REIT fund. That's your foot in the door today. Vanguard Real Estate ETF is a solid choice. It costs you nothing to start learning while the market does its thing. Second, spend 3 months studying. Read LoopNet listings. Understand cap rates. Learn what drives NOI in different property types. Third, when you're ready, allocate a small portion of your portfolio to a private real estate platform. Start with the minimum. Learn the cadence. See how distributions work. The beautiful thing about this market is that it rewards patience and knowledge over flashy moves. You don't need $1 million. You don't need to know the right people. You need to understand how the money flows. And now you do. If this video gave you something useful, share it with someone who's been sitting on the sidelines wondering how to get started. Hit the subscribe button if you want more breakdowns like this. I've got a lot more coming. See you next time.